Live. We're here 8:30 a.m. on August 2nd, 2022. This is the show where we're taking a whole bunch of artificial intelligence and we're bringing you insights on how that AI model is viewing the market to come. Today, we're going to be looking at the back half of earnings for this week. Yesterday, we were looking at Monday and Tuesday for earnings releases. We've got a couple surprises. Pinterest coming out being extremely positive. Now, Pinterest just knocked me out a little bit because I'm Snap coming out and having such weakness in digital advertising, and then coming out and seeing Meta's struggles with advertising. Google's been doing fine, but they're kind of the digital advertising premium name, right? Pinterest coming out and being so strong shocked me. I don't know about you, Tyler.
Yeah, and I guess we should have seen the writing on the wall. There has been some hedge fund buying. I believe it was Elliott in the name. Generally, when things like that happen, the game is afoot, Trebek. But that's just it's one of those things about that's what makes markets beautiful, right? There's so many other ways to move price other than just predicting fundamentals, right? I think we've been seeing some pretty big buying in the call space and Pinterest going into earnings, and now we kind of have your why. Yeah, it's pretty interesting. Congratulations to the call buyers. That's definitely one we weren't involved in. Wish we were, but on to the next.
They're up pre-market 18% right now. I know right when they released yesterday, they were up 23%. So they are sinking a little bit coming into the open today. Definitely not something that I would buy right now to try to catch that afterwind. But yeah, that was an opportunity. I'm grateful. So I've been mixing in this week, not just earnings, but also just trades based on Foliko's model of equity price prediction model. And so that has been working out well for me. I think that those two things working in tandem are catching different parts of what's happening in the market. So I think that's a really positive thing to be mixing those together. But Tyler, what are you seeing for Monday, Tuesday, and trends that we've been seeing with our earnings call this week and last week?
It's been kind of a mixed bag. It's really we've been at the mercy of market directionality here. For example, Caterpillar, I believe, posted some pretty solid earnings this morning and is getting drubbed. I think it's down about 4% here. So it's getting the numbers right by themselves has not necessarily portended good profitable trades necessarily, because you're in the hands of the directionality of the market in addition to the earnings gods. So that's something that's been a bit frustrating for us. The good news here, it looks like the first trade of the week, the LSCC short, is going to open red. We will see how red by the open, but after an initial 2% pop, it's given all that back and then some. So we'd like to see that. This is another week where we're generally bearish semiconductors. So let's we'll see how that turns out. We're also going to be. We were bearish on, and then we were bearish microchip here after the close today.
Tyler, it seems like to me the bar has been lowered for big tech companies. If you're in this club you are part of the new big tech company group, and I think FANG has been completely reshuffled. So Meta is out, Netflix is out, but Alphabet, Microsoft is part of the new club. Amazon, Apple. Certainly these four tickers, it almost didn't matter what they came out with and said. Microsoft coming out and saying, oh yeah, foreign currency still a real big headwind for us. Earnings down, not what we predicted. But the market didn't care. Meanwhile, Walmart's going out and doing everything they can to be transparent and honest, and they just are getting shellacked out of that. And it's a lot of excess inventory from people overbuying on the supply crunch. But at the same time, it has been difficult to navigate. I mean, even if you're calling the earnings right directionally, it's difficult to navigate the reaction to that. And that is very interesting to me. It's almost like there's a club of in and out.
Yeah, and yes, I think that's right. And like we were talking about off air yesterday, what is your definition of tech? the definition of tech changes. Is it the stuff in the ARC portfolio? Is it, quote, innovative tech? Is it?
It's not the stuff in the ARC portfolio.
Is it FANG tech? Is it software? Is it semis? Like,
yeah.
What by tech? What do you mean exactly? And I think that is a big going to be a big thing going forward. Is making sure that when tech does bounce, you're long the right tech, because I wouldn't be surprised to see some of these names that were former leaders and high flyers to be kind of left trampled in our wake here, while we give birth to new leaders and different leaders as well. So that'll be interesting to watch. Is, what do you mean by tech is really the question.
So I have a running theory, and I do want to present this today because I've been doing some research over the past 24 hours to get my mind around a little bit of the phenomena happening right now. And I think that what it is cloud technologies have proven to be one of the most resilient forces happening in a chaotic market. And so companies with large exposures or assets in the cloud space are really winning out. Apple is outside of that theory. They're not really too invested in the cloud piece, but at the same time, a lot of their products have been surviving quite well. So I think cloud is holding up well, but I see a really strong headwind facing these companies. I think that this is going to be the decade of antitrust. I think that we're starting to see some more boldness on stopping more and more acquisitions. And historically, these big cloud names, Amazon, Microsoft, Google, which, by the way, I'm currently employed by Microsoft, so I want to be very transparent on that. I love Microsoft as a company, fantastic, but we're talking stocks here, just numbers. Their appetite to consume in order to grow is insatiable, but I don't know if this is going to be the right environment for that going forward. So I see antitrust being a barrier to continued innovative growth through acquisition over the next decade. And that's a real problem for these companies. Think about how Google and Microsoft and Amazon have really grown. It's through acquisitions, and now Amazon's coming after the next big healthcare provider. They've been trying to disrupt as many industries as possible, but they've failed by and large. Now they think they're going to do it with this latest acquisition. But at some point, that pipeline, that faucet of acquisition is going to dry up. I don't see how these companies can continue to grow at the pace they have been through that method. Tyler, thoughts on that?
Yeah, it would seem that new levers would certainly need to be pulled. What worked the last 5 years and what got investors excited, I think, is kind of run its course. So we're going to have to get something else to be excited about. And that's one of the things I think about in terms of what stock should I be looking to kind of buy and hold for the next repair and intermediate bull market. And that's really what I'm struggling for, is what's the next thing. We've paid some decent lip service to biotech here. Health related technologies are certainly in the next 10 years, but like, what else? That's really been a struggle for me, is what does the next 5 years look like in terms of new innovation, as opposed to previous innovators just kind of bolting some Frankenstein stuff on it, if that makes sense. So we'll see how that all works out. To segue, we don't see a lot of growth in a lot of these companies this week.
Nice segue.
I mean, and again, so we have MGM, which we spoke about yesterday. Casinos are improving somewhat. That's a pretty tidy beat there. Clorox, which also makes sense, would be a defensive. But the rest of these, not so good, man. I mean, I'll tell you that I did see some recovery in the health scores in Under Armour and I believe that's Toyota, as well as Moderna, which is why I'm not pitching it as a short, even though we have a pretty nasty combo there. But I just don't. I want to observe this one, especially because it's a bit more of a funky name. But generally speaking, not good. Robinhood, not good. eBay, not good. Melly, not good.
What does it say to you that MGM is up and Wynn is down?
I think, well, top of my head, that's the U.S.-China differential potentially, and that's my best idea. But I'm not necessarily sure. I'd have to look into what the nuances between the two of them are. I know they both control high-end casinos and operators. Maybe it's because MGM also controls some low-end properties as well. Maybe we like that. But I'm not going to say with any with any certainty, but I definitely do think it's interesting that we have MGM outperforming Win. And that's something we like to see because we like to see relative strength. We like to see things stick out amongst unimpressive, a basket of unimpressive stocks. We want to see the one stand out and shine. And that's certainly in this case, MGM. But aside from that, again, not a great picture for this, this is tomorrow.
And now we started talking about this yesterday. I want to reiterate today. We are seeing bearishness on China exposure left and right in the models. Like that's right now just a poison pill for companies being exposed to that. I think that Boeing, if you want to look for tickers that are highly exposed to that mess, Boeing is going to be a big one as China is considering whether or not to be going with French-produced planes or Boeing contracts, right? Which China's already committed to. It's already been priced into the cash flow. So if they go back on those contracts, that's going to be a huge problem for Boeing. But right now it's a political football. And so Boeing's future, and it's kind of gross how much they're sucking up to the CCP right now in order to get those contracts going through. I hate over and over and over again U.S. companies sucking up to the CCP trying to get these contracts out. There's nothing wrong with China. Great people, great place, but economically and government-wise, they've got a few difficulties they've got to work through in order to see continued growth. And so I get worried about that kind of exposure, and I do think that is dragging Win down quite a bit. By the way, mysteriously, yesterday when we were talking about this, my internet froze.
Yeah. Oh, yes, they did. They threw you off the air for your insolence yesterday. So one I will point out, and this is just the old rates trader in me. So TW down here is TradeWeb. That is it's a fixed income trading platform, e-platform. Given all the volatility in bonds, I wouldn't be surprised to see that number be a little better. It's not something I don't. Given the technical shape of this chart, I'm going to leave it alone. But I just, my trader lizard brain says there's some potential for upside there. This has been as good a year for bond market making as there has been. So that's just something to
now we'll say this, Tyler, in the interest of just being really out in front of it, our models this quarter have been too bearish.
Yes.
My calls have been big winners. My puts have been half and half on the basis of these models. So does that mean that we need to give a little bit of leeway to companies? And if so, which companies?
Yeah, that's, again, we were talking about this before the show, but that's something that I think has muddied the waters on some of our calls. For example, trading earnings on Fed week. Very difficult to do because whatever the reaction to the Fed move is really going to muddy the earnings reaction, i.e., if the market's doing well and a name reports some suboptimal earnings, that might get forgiven in the context of an overall market rally. So that's the thing that is the final piece of the puzzle for this, is just making sure when you're entering these trades, you think about positioning. That's something we talk about all the time, is how are people positioned into it. It's not enough to get the number right. We need to know how they're going to react, and a way to figure out how they're going to react is to figure out where their pain points are and how they're positioned. So yes, if we do see the market rolling back over, any upside earnings trades we have here will probably be muted, and the ones on the downside will probably have more leeway, i.e., there are scenarios where companies beat earnings and they sell them anyhow, and that works out in our favor. So Caterpillar. So we'll see how that works. Given Foliko data is still so bearish, I have to give it some leash on the bearish side. I think that's the only appropriate thing to do here. Even given the good market move off the bottom, I think a part of being systematic and programmatic is you stick with you never run away from the offense, right? So that's what we're doing here. We believe in our stuff. We believe in our models. and we're going to keep fine tuning and working through them to the extent that we can further increase risk reward.
By the way, if you deep dive into Foliko data, we are seeing this as a bear market rally, and one that's not going to be sustained. So I think it's since early July, if not late June, market's been charging upward, back up to what, 43 now. Our data has that.
We're at like 40. We're at 41. Yeah, we had talked about 43 as the short target.
Okay. Yep. So something to keep in mind, and I think that the Fed is pretty determined to get us down below 4 again. So I think they're doing everything they can, and in that environment, it's just not something I want to bet on. Wall Street Journal put out the other day, retail investors are really going all into those big tech names that we talked about just now. The new FANG. And whenever retail's piling in, it makes me nervous in big numbers, right? Unless you're a Foliko subscriber. Yeah. All right. So for August, what do we got?
So for Thursday, we have 2 trades and a bunch of thoughts. So if I can just jump right to the trades. If anybody from Restream's watching, I will pay you good money to share 2 screens at once, I promise. So we have 2 trades here. The first one is going to be Eli Lilly. So this is a tier 2 trade. I don't like the fact that line is the earnings power is flat, but we have to bet on a reversion there. We just have to. I bought the 330 puts for 8 yesterday for record keeping purposes. We just see mean reversion here. We see a small miss as well. And in terms of technical location, this is a good spot to short it from. So this is one that has our interest. It's probably my second best idea for the day, because my first best idea yikes. So that's Monster.
It's interesting that both of these are looking the same between Eli Lilly and Monster. Is that what you have? The divergence doesn't come from a shifting earnings power. The divergence is coming from just a stock price that has charged upward without earning it.
And we got a lot of that. There's a lot of, and I mean, this one has turned up more recently, Moderna, but I generally saw, when I was going through this, I saw a lot of earnings power that was negative and flat with a stock price that had completely run away to the upside, which to us means it's more been it's more of a squeeze than a fresh buying driven by somebody changed their mind about fundamental value or something like that. This is another good Monster is at a really good technical spot to short, actually. I really like that one. But there's a lot of other names in here, man.
Wait, what contract would you be doing? What period?
These are all weeklies. If we're betting on just earnings, we're doing weeklies. Especially because I'm not a financial advisor. I'm just saying, if you just do the earnings bet portion of it and are wrong, you can then enter again from the more advantageous level, as opposed to having a longer term trade that's neither here nor there and kind of impaired. You can take the view, have the view, settle the view, and then take a new view, as opposed to kind of trying to blend your views together and getting one kind of crummy view.
And by the way, that's exactly what I did with Google, and how my portfolio is doing better than it should have. I will say I'm bleeding from Pinterest, but that Google short is helping me out quite a bit. I'm now in the money on it.
Check this one out. This is one. I've talked about ABBV. I've talked about AZO. I've talked about names that I like to short late into a bear market that haven't had a chance to get knocked over yet. So we don't have an overly bearish call per se on this. And oh, look at that. Okay, so when I checked this out this weekend, this thing was on its butt.
Oh, look at that charging up.
So
Holy smokes.
I will wait for after earnings on that one, given that change. I just saw that. I had been on Foliko a night and a half ago, and look at how much that's changed. So we will not be trading that one. But Cigna, I got my eye on you for a short. Maybe I'll get lucky, and we'll have a green resolution to earnings, and I can sell the green. That's definitely a PA trade I really like if they give me a good level into it.
So, Tyler, I did an experiment last week. Something I just want to mention. I saw something like this where I wanted to go short, and yet I saw the short-term earnings power just accelerating like hell on it. So, you know what I did is I actually bought a couple calls to resolve before the earnings, and that earnings date became the get out signal for me, and that actually ended up working out quite well for me.
That makes sense. There are opportunities to trade the earnings run up if you're willing to trade that, and you're willing to exit. That's the most important thing in any trade. Is it's easy to enter a trade. Are you willing to exit? Will you just take I don't care if it feels good, it feels bad. Are you willing to exit? So if you are willing to
IDXX
yes, that was a good trade.
I cleaned off 25% on it, and then they shot down.
So yeah, so that's an interesting one. That's something we're definitely monitoring. I use that as a cancel signal on a trade where if we see a big run up on the 1 day, even if I thought I had a bearish divergence, that'll basically filter that out and eliminate it as a trade. So you just saw that happen there in real time, because I really am looking long and hard at Cigna as a short. That's a cross process trade. That's Foliko. That's my positioning stuff. That's pretty much everything.
What does that mean for possibly even taking both sides of it?
Well, if you want to trade the straddle, so I always talk about we're not trading the straddle here. We're just taking a one-sided directional bet. You can buy the straddle. You can buy the at the money put and call and get paid for, as long as you get an outsized move. The trade pays, but the straddles going into earnings can generally be 6, 7, 8, 9, 10%. So you have to be betting on a pretty big move to make an earnings straddle worth your while. They are, we can definitely start to look at that and isolate the straddle as opposed to making a directional bet. But that is the risk profile changes.
Well, so unless you believe, though, that there's going to be a difference in a movement pre-earnings and post-earnings, in which case you can benefit off of both sides. So I'll tell you this. I saw this with what was one of the tickers last week. We saw a huge pre-earnings movement, which I wish I could have benefited off of, because I saw this motion happening in the earnings power. And then the earnings came out, and it made my original trade profitable. But I wish that I had been able to clean off some on that pre-earnings movement at the same time.
So that's called a. Hang on, let me go over here and run this caption before I try to drop any of this knowledge.
We are not financial advisors.
Yeah, before I start talking about call calendars, we are not financial advisors. So to your point, there are structures whereby, for example, you can sell a call at a near date to buy a call at a far date. Basically, you're expecting nothing to happen in the short term and then something to happen in the more longer term, I guess, even if it's a 1 week, 2 week kind of structure where you're short the one call and you're long the second one a week later because you're betting the catalyst won't move it enough until the week after or something like that. But yes, there are different option structures to take advantage of exactly how you think the path is going to be. And that's what I think is interesting about this is we make path dependent price predictions. So to the extent that you have a model for the path, you can, in addition to just buying options, you can potentially sell options where price isn't going to go, because knowing where something isn't going to go is just as important as knowing where it is going to go.
I'm distracting you a lot, Tyler. Let's get back to it.
No, this is good. Nobody wants to hear me drone on about earnings. I gave you guys our 2 trades, and really, if I could just zoom out here and have you take a look at column F. I mean, look at that. That's a lot of red there. Mm-hmm. Pardon me.
Square's an interesting one. Given its exposure to crypto.
Square and PayPal this week. To me, the most interesting part of this will be the follow. I think it's going to knock the pins down and set up a whole new board for us to trade, which I think is fantastic, because this board has been getting kind of stale. So that's really my biggest hope is we're just essentially shuffling here, and when we come out of this, we'll be able to provide some really good, clean sector views. And that's why we've been more focusing on earnings than sectors during earnings season, because as we pointed out, if you have a good call on a sector, broadly speaking, but earnings aren't cooperating with you, it's not really a good call. So we like to see these things clear. When you are betting on earnings, we like to be clearly betting on earnings, and then once those clear, we would prefer to make whatever the prevailing data from Foliko tells us to do, which at the moment is still bearish.
At Square, I was looking at the chart in Foliko for that one. I mean, there's no pulse there. No one's talking about it. No one's hoping for it. I'm not seeing much to really. I mean, the stock price is shot downward. So is that problem that we're seeing there in E73 already priced in? That's the big question I have there, and I don't know that I'm confident enough to call that. So yeah, I guess leave that one alone.
Those are tough. We'd rather trade those on the follow. For example, if they squeeze it a ton, then we'll short it. If it dumps a ton like Roku, then we can buy it. There's no hurry. If there's no edge, there's no hurry. That's really the size of it. And in this case, we think we have a couple edges, but aside from that, no hurry.
All right, gang, we got to let you go for the day. We got to get to trading. Tomorrow, I'm going to be out. I'm doing a little procedure. And so we're going to be back here, Tyler, Thursday morning, 8:30 a.m. Thank you, everyone, for joining. And we will see you in 2 days for more Stocks to Watch with Foliko Live. Thank you, everyone, for joining.